Good afternoon, everyone. I'm Lydia Tomkiw. I'm a reporter with Pensions and Investments. I'm going to let each of the panelists introduce themselves and their firms and give you a little bit about where they come at the fundraising and due diligence angle from.
Perfect. I am Addy. I am the founder and CEO of Castle Hall Diligence. Despite the English accent, I'm based in Montreal. And we have two businesses. We, first of all, work with investors, LPs, to conduct operational due diligence on the asset managers to which they deploy capital. We work with about 250 allocators worldwide and currently cover about 2,100 GPs for initial and ongoing due diligence, about 5,000 fund entities. So we see enough of a lot across the industry. And then secondly, we are building a platform which allows general partners, managers to share industry standard due diligence, which has been independently verified by Castle Hall to really speed up and validate the capital raising process. I'm a firm believer in trust but verify.
Rich Itri, I'm the Chief Innovation Officer at ECI. Been with ECI now a little over 4.5 years. I have almost 30 years experience in the industry managing and running enterprise IT programs. I worked at several hedge funds, private equity firms, and investment banks. ECI, for those of you not familiar with it, our signs are all over the place, I think, this week. But we are a global MSP. I would say we're a modern MSP. So we cover the entire IT stack from your traditional MSP services through to cyber, data, and AI. So great to be here. I spent a lot of time with clients on their strategic IT roadmaps, bringing my experience to the table in terms of working at various funds, and have a lot of insight and expertise into best practices, what aligns with the industry, and what the regulators expect.
Hi, everybody. I'm Laurie Goodman. I'm Global Head of Investments for Jefferies Private Wealth. I oversee our advisory business and our alternative investments platform. In alternative investments, we're allocating across hedge funds, private equity, private credit, and real assets.
Hi, I'm Marlin Naidoo. I run the Global Cap Intro team at BNP Paribas. Effectively, our team works with hedge fund clients that prime broker with us and introduces them to allocators across institutional, intermediary, and the private space on a global basis and based in London.
Great. I'm going to stick with Laurie and Marlin down there. So it's no secret, raising capital is difficult these days. What does the environment look like from your seats? Where are institutional investors putting capital, and what do you look for from your seats?
I'll start. Look, I think the obvious place to think through is think about what's happening with rates. And rates are such a huge determinant for where the opportunities are and what is interesting from an allocator standpoint. Now, there are some allocators out there who are going to have the purview to only invest in equity long-short hedge funds or macro strategies or something like that. But if you're somebody who's taking a wider lens and saying, okay, what's interesting? Well, a couple of years ago, the market gave us a gift. When real rates started to rise and the risk-free rates started to rise, capital was moving really aggressively into private credit. And you were getting an equity-like return with a credit-like risk profile. And people who are really focused on hedge funds, I think, were kind of scratching their head and saying, what's going on with the markets? How come nobody's returning my calls? And so you want to think about what are the market dynamics and what's relatively attractive. And I'd say, the other big shift that we're seeing occurring in the market is that capital is moving, nothing revolutionary here, but capital and markets have moved from the public side to the private side. And as a result, that ecosystem in alternatives as an allocator means that there are more and increasingly interesting opportunities on the private side.
Okay. So I think in terms of what we've seen alpha increase in the hedge fund space from 2023 to 2024, a meaningful change. And I think the interest rate piece that you mentioned is quite important, because what we are then seeing is we are seeing managers, which I think would be good for hedge funds. We are seeing investors looking again at active management. So the potential now to have a shift from passive management into active is something that we're pretty excited about, because I think what we saw in that period where it was like everybody's making money was moving into passive management. And then as it pertains to what that means for hedge fund managers, the strategies that we are seeing the most amount of interest in, equity long short on the lower net side, credit, we've seen that back to back for the last couple of years. We are seeing a resurgence in Asia, less so China, but definitely Asia Pacific. I think particularly around markets like Japan and India have been coming to the forefront again. And last year, we saw some really good returns from Asia equity long-short managers who tend to have less China. And so I think allocators told us last year that they wanted to increase Asia Pacific, but they didn't really do it. And I think this year would be a time frame that they would look to do that. So those are kind of the areas that I'd say where we're seeing activity.
And just sticking with you for a second, a lot of the allocators I talk to these days, separately managed accounts, fees are still a big discussion. What are you seeing from the practical structuring side in your seat, Marlin?
So separately managed accounts, I think, is sort of the big thing that's been happening over the last couple of years. I mean, the biggest hedge fund launches have been at the back of taking in money from external SMAs. So I do think we're going to see more activity in the separately managed account space. I do think hedge fund managers, be it new launches as well as existing, have to be a lot more open-minded to the opportunity set that there could be in terms of raising capital from multi-PMs who are doing external managed accounts, but also end institutional investors who are shifting from commingled structures to having stuff in the SMA space primarily driven for cash management exercises. The other piece that is incredibly interesting right now is hurdle rates. It's been talked about. I think if you sat down 3 years ago, 4 years ago, no hedge funds were really doing it. It was the unknown word. You just not see it. Right now, it's a complete shift. You've got a lot of allocators who've asked for it for a while, and now they're getting it. You have a decent amount of allocators who will not do new allocations unless there is a hurdle rate in place for specific strategies. And you have hedge funds who have started doing it. And they've not only doing it, they are not only doing it because they need to raise capital, but they're also doing it because they think that they're moving with the time. So I think the hurdle rate piece is an incredibly important structural thing that's changing from a fund term standpoint. The other thing that we are seeing is raising capital in commitment structures. So, obviously that's the way you do it in the private world. We've started to see that move into the public world, and I think that does create business stability. It creates some really good incentives for managers when they're bringing in people. So that's something that we think. I don't necessarily think that that's going to grow. I don't think a lot of public managers are going to be able to command committed capital, but it is something that people are looking at. A lot of managers will probably stay on the waitlist side when they close versus doing the committed strategy. And then the last piece from a structural standpoint is really the growth we expect to see in and around portable alpha. So I think more managers kind of looking at implementing portable alpha and delivering something to allocators in a off-the-shelf product type of way. So that shift from sort of active, from passive to active, and the shift from long-only investing into hedge funds, we do think that as people move from long-only equity, and they think we are moving into more alpha generative environment, that having a manager who can give them a portable alpha product, which gives them a 100% exposure to whatever index, and an alpha ported on top of that, we do think that that's going to be something that, we have already seen it. We do think there's going to be more of that.
And just starting with Chris, going down the line, what are the must-haves for managers to get through the doors these days from all of your seats?
Well, I guess I'm a little bit biased because I'm going to be thinking about non-investment risk, but I did actually attend a conference recently where a speaker made the point that 24% of the investment decision is related to performance alone, and 76% covers a broader aspect of the overall partnership and relationship that is expected to be in place over the duration of an allocation. So I think from our side, we certainly feel that an asset manager that is invested to build a good quality, stable, and durable organization, ceteris paribus, all other things being equal, if I build a better factory, I will produce a better widget. Except in our industry, of course, our widget is investment performance, not a physical good. So I think there is increasing focus from investors on the quality of operational infrastructure and an increasing opportunity for managers to differentiate themselves as a GP to really be able to say we are building a solid, well-controlled business. We have, whether it's compliance, information technology, data management, these are all very strong areas. And I would just actually put one other point here to get through the door. there is a penalty for being different. And oftentimes we'll come across a manager and they just got to be in their bonnet about something. You know, we won't do a valuation committee because we call it it's the quarterly investment review. I always like to say that, look, I'm British. I learnt to drive in a manual car on the left. I think it's a bit of a silly idea driving on the right, actually, but if I try and prove my point on I-95, I'm going to realize it's just not a hill to die on. Just go with the flow. You know, you don't want to have an issue with wasting time with ODD just because you've got some, you know, unusual characteristic. Be aware of what standard practices are, what best practices are, and follow the recipe.
I think continuing on to what Chris said, to kind of look at things, you know, from my view, I look at it from two lenses. One is for up-and-coming managers or newer managers versus the enterprise, so more established firms. I would say for up-and-coming managers, it's really important you understand that it takes an engine, a really good engine, right, to make the organization run. The investment side is critical, obviously, but I think oftentimes, you know, people don't think about the operations, the technology, the accounting, compliance, risk that goes into running the organization. I think now, like where we are in the world, when you think about AI, you think about data, you think about cyber risks, technology is increasingly important. And that initial upfront investment is critical. It's critical. They're looking at it from a due diligence perspective. The regulators are more stringent around it, you know, as well. You look at what the SEC is proposing for RIAs now, as well as what you're seeing in Europe with DORA and across Asia, UK with NIS2. There's a lot of challenges, right, that face new managers, and starting off on the right foot is really important. I think thinking strategically about where the organization is going, how you want to manage data is really important as well, because I see a number of large enterprises who have grown up not thinking about those things, right? And again, people are looking at that when they do due diligence around how you're curating data, how you're reconciling, managing it on a regular basis. For looking at more established managers, one of the big things I see is you're not kind of doing what you say you're doing, right? So if you have policies and procedures in place, you need to be executing and aligning with those, right? That's the first thing that the regulators look for. It's the first thing you see when people come in for due diligence. And it's the first area when I come in to help clients where I see holes, right? And don't always set the standard to be something, again, like being too different, right? Align with an industry standard and make sure you're executing to that. That's really important, right? And you know, it's becoming increasingly important now too, from a cyber perspective. I can't tell you the amount of risk, right, and how much that is increasing. And I see organizations always looking to figure out ways to leverage their IT budget further, and I can tell you that is not an area to skimp on.
So I'll double down on all of that and say that having a well-built, thoughtful infrastructure is critically important, and it's table stakes, because all of the managers that we would ever consider investing in have to get an important seal of approval from an ODD perspective. Beyond that, from an investment perspective, we're really only looking for maybe 3 to 5 new managers across all of alternatives in any given year. So we get to set the bar pretty high in terms of those partnerships. And so I get drawn to areas where a manager may have done something relatively creative, from a structure, maybe from an origination standpoint, maybe the assets that they're focused on, where they're doing something that's different, that's going to enable them to deliver a better risk-adjusted return. And I really like to look for consistency. When I'm going out on the liquidity curve for longer lock vehicles, I want the benefit of some kind of major secular tailwind that's also going to boost the return of the manager.
I mean, I would just repeat all of those things. I think the thing I'd go back to the beginning is flexibility. I think that's a big key thing. Alignment with investors, I think, is incredibly important. So thinking about that. I think you're going to touch on this, but the technology aspect, I do think that most managers I meet with at various cycles are at very different stages as how they use technology to make them very much more efficient. So AI is incredibly available, and people could be using more of that, but maybe going to touch on that a little bit.
Yeah, just one last question on this front. I mean, a lot of brilliant investors, when they go to launch a hedge fund business, maybe have never done the business aspect of launching. So is there anything, maybe Laurie, Marlin, specifically you look for when somebody's going to start a business for the first time?
Yeah, I have a lot to say about that. I mean, I'd say a couple of the more common mistakes that I see is somebody was a phenomenal analyst, investor inside their former shop and is now starting their own fund. And maybe a bit myopic around what it actually takes to start that business. And I've always held the view that you have two books. You have your book of investments and you have your book of investors. And without those two books working in collaboration and building a good investor base and knowledge of how you're going to get there, you may be a phenomenal investor unless you actually have the capital to execute and build the infrastructure that's important to Rich and Chris. The business is not going to be a success. So I'm also underwriting, okay, well, you've been a good investor and you've had to underwrite CEOs and businesses. Did you actually think of yourself as a business owner and do the diligence on all of the things you need to do correctly to make sure that you can actually execute your brilliant investments?
So I think for people who come from the investment side, I think there's 9 times out of 10, they underestimate the importance of a really good CEO/COO. And the person who can run the non-investment side. And you see it over and over again. I'm not sure why it's not changing. There is the instance where you will find a really good CIO who has complemented himself with or herself with the right CEO/COO to run that entire business, who's done that, who has an experience of it. It comes back to that 25% performance stat. People are investing in performance equally as so they're investing in businesses, right? And so you need to have a well-run business. And the star trader who's performed really well, again, a lot of times has never really run a business. And so my guidance when I meet PMs, because I'm generally meeting PMs first before the business is formed in a lot of instances, is find that other right person who you will trust and give them the full autonomy to run that business, and don't step into something that you've never done before, because you should let them take control of that. That would be my guidance.
All right, turning to AI, because we can't not talk about this. What is it doing to due diligence? I want to go to both Chris and Rich on this and the aspects of what you both work on.
I have to say I am incredibly astonished by the capability of AI. I really do feel that it is an industrial revolution. I'm actually very surprised at the relatively tepid levels of adoption and interest. I'm an accountant, not a technologist, but we are building a RAG, a retrieval augmented generator. It gets great results, and yet when I'm chatting to my peers in the ODD community, there is not necessarily even understanding of what something like a RAG is, and that's really AI 102. It's not particularly complicated. But to give an example of what that has been able to do for us, we built a database of all of the registered investment advisors and ERAs. There's just over 22,000. We also have records of about 8,000 service providers that are listed in the ADV filings. And we said, well, we'd like to write a brief business summary. Know your general partner, know your service provider, KYGP, KYSP. And we figured out it would take, an analyst. We have a team in Manila. They could probably take a morning or an afternoon. They could do a couple a day, do the research, write it up, figure out who's ECI, and get it reviewed, put it on the platform. It would take a team of 10, 6 years, 2 months, and 4 days to go through that volume of work. We use Anthropic. It finished in 12 days. So the leverage that comes through, AI is really providing an unlimited team of junior analysts, which does also create a number of other elements and implications for how we run our businesses, how we train new entrants to our industry. But I think the leverage that is coming through is absolutely astonishing.
AI is exciting, right? It creates a lot of opportunity to make business processes more efficient. It gives you the opportunity to look at things through a fresh lens. if you think about it through a due diligence lens for a second, I see a lot of organizations very excited about AI and jumping into it way too quickly, right? They forget all of the best practices that we've been following around vendor due diligence, securing data, not using open source tooling, not using, putting your proprietary information into some of these public platforms. I'm shocked because I think everyone's so energized around it, right? And the natural language aspect makes it very intuitive to use, but don't forget best practices. Allocators, people who are doing due diligence are asking us questions that they should be asking managers around, how they're using AI, right? How they're securing data. Don't forget those best practices. And also, even if you're using third parties, like so you're using Salesforce or NetSuite, do the due diligence. I'm not going to name third parties, but I can tell you they're rushing to deliver solutions, and they're building shared models maybe, right? Or shared vector databases, so you have information that's becoming commingled, right? So just don't turn something on because it's there. Do the proper due diligence around it and rethink data security across your organization, right? You wanna be using sanction tools, right? Tools are secure, where your data is never gonna leave your four walls, right? You're not gonna be learning open source models and things like that. It's tempting when you look at some of the tools that are out there, but you have to put some controls around it.
Let's stick with you on cybersecurity then, and what you're seeing on that front. You alluded to it earlier, so walk us through that a bit.
Look, I've been doing this for almost 30 years, and I felt like at some point things would kind of level off, and it hasn't. I can tell you the threat landscape gets more complex every day. The threat actors have gotten very smart. AI has fueled this as well. The Nigerian prince email is now a very well-constructed email that scrapes social media, knows everything about you, where you've worked, who you work with. So people really need to start focusing on developing a well-thought-out cyber program. And that really is about thinking about defense in layers, right? Having all of the right technology in place, but also all of the right processes and controls, as well. I think, as I mentioned earlier, even with emerging managers, it's easy to start out and build that from the beginning. And it's very important, I think, you do that, right? And you have the right partners to help you with that, as well. Business email compromise, it's a very kind of common threat. Ransomware is getting more complex to stop, right? And you have to remember, these threat actors make a living off of this, right? This is how they feed their families. So they're getting more and more, innovative in the space.
Can't help myself. I'm a reporter. I like real stories. Chris and Rich, any no-nos recently you've encountered, red flags in due diligence you could anonymously share with us?
I was going to give the example of how I went to the office of Bayou Capital Management shortly after the disappearance of Sam Israel, and I saw the bullet holes in the wall. That was, I would have plastered it over if I was the new tenant personally, but anyways. I once had a fraud, and it is the strangest feeling. And I was on the phone with the manager. Was weird. The whole thing sounded, there was just a not right feeling, but we found the fraud by talking to the administrator. So part of our process is, hey, can we corroborate the life of a trade? Let's just walk through how you get trades into the system. So I said, what's the source of your trades? They said, oh, easy. We get a daily email from the prime brokers, which lists the trades. Okay, fair enough. Can I just confirm which prime brokers? Obviously, trust but verify, make sure I corroborate it's Goldman, Morgan, etc. And he goes, no, it comes from the prime brokers. Which ones? The prime brokers. I had the presence of mind to say, what email address does this come from? And the CFO very, very positive, the administrator very positively said, oh, it's easy. We get a daily email from trades@primebrokers.co.uk. And I had the presence of mind, it's such a surreal moment, I had the presence of mind to look on Whois, and I could found that the domain primebrokers.co.uk had been registered on GoDaddy.com by the CFO of the fund. The dummy hadn't even used anonymous domain registration. So that was a no. That was a fail.
It's tough. I don't want to share anything recent, right? Because we have a lot of clients who could be in the audience. But I will say, given my 30-year history, I've seen some unusual things. I did have a manager come in my office, throw his BlackBerry at me and say, look, I need you take my PIN off this device. It's costing us thousands of dollars every time I have to log in. And I tried to talk him out of it. He wouldn't listen. 2 days later, he lost that BlackBerry on a plane and had 20,000 contacts on it. Needless to say, none of us slept. I begged and pleaded Delta Airlines to try and find it. We couldn't remote wipe it. We never showed up. Now, the contacts never leaked, but he came back in on Monday and said, let's do a complex password. So, yeah.
Well, on that note, thank you very much to all of our panelists for the great stories and insights.
Thanks.